Welcome to Every Dollar Counts with Josh and Jay, a shot of true serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, Director of the Gulf Coast for Concourse Financial Group. We are brought to you on the Gulf Coast Financial Advisors Podcast Network. Well, today, listeners, we're going to tackle something that I personally believe is the single largest potential destroyer of wealth in retirement. That's an extended healthcare event. Particularly, how does someone handle that extended healthcare event, or what some people refer to as long-term care? Jay and I are going to discuss the different ways people tackle this potentially huge expense of long-term care, and we're also going to compare and contrast those different strategies. But before we get into all this, though, let's have our friends from Sloth Racer kick us off. Jay, buddy, how you doing today?
Josh, doing well. Good to be with you here in Deep Fried Studios and with producer Johnny Gwynn. And the springtime is coming around. It's
Mardi Gras.
It's a little bit warmer. We got Mardi Gras going on. It's good to be with you.
Yes, yeah. And listeners, if you want to hear a little bit more about Mardi Gras and what it looks like here in the Mobile area, go back a couple episodes and Jay and I give a little festive description of the history of Mardi Gras Mobile, especially because it started here. So quick housekeeping for compliance. Jay Stubbs and Concourse Financial Group are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And me, Josh Knoll, I'm not affiliated with Concourse Financial Group. So Jay, before we dive into the different strategies for affording a long-term care or an extended healthcare event, I'd really like to start with, what are the triggers? What defines a long-term care event?
So, Josh, I get this question a lot, and I've tried to simplify it through the years. I've been in the business 25 years, 23 full-time. I found a song several years ago that made a lot of sense, and it's the Beatles song, A Day in the Life.
All right.
And those of you listening to this podcast driving down the road, I apologize in advance. You may be singing the song the rest of the day, but there's a certain segment of that song that says, woke up, fell out of bed, drag a comb across my head, found my way downstairs, drank a cup, looking up, noticed I was late, found my coat, grabbed my hat, made the bus in seconds flat. So if you think about it from those lyrics, and again, I apologize for those that may be singing that song the rest of the day.
Well, you just channeled the ghost of Paul and John there. I don't even know who sings that.
Paul and Ringo, and yeah. So my intent here is to explain that there are 6 activities of daily living. And if your primary care physician tells you that you cannot perform 2 of those 6 activities of daily living, then you are deemed to be in need of long-term care, whether that's at home or in a facility. The triggering event could be anything. It could be stroke. It could be serious complications from an illness such as cancer. It could be a cardiac event that puts you down and out. It could even be a more cognitive issue such as Alzheimer's. So there are many triggering health events that can occur. It could be an accident in the car.
Right.
And you're now maybe in a wheelchair or need assistance from someone else to help you get through those activities of daily living. You are deemed to be in long-term care need. You could be 20 years old or 60 or 80 years old. It just depends on those 2 of 6 activities or cognitive impairment. So what are the activities of daily living? Back to the song, A Day in the Life. Well, the first thing we do in the day is wake up. We have to get out of bed. So mobility. That's the first activity. The next thing that we do after we get up is we make our way maybe to the restroom and we shower, we bathe, we get ready for the day. So bathing and toileting, that's also included in that. That's the second activity. What do you do after that? You get dressed. So being able to clothe yourself, put your clothes on, that's the third activity of daily living. The next activity of daily living is going downstairs and fixing your breakfast. So you have to be able to feed yourself. So feeding yourself would be the fourth activity of daily living. And then what happens after we have the coffee and the breakfast? Right. We have to go to the restroom. So like I said, toileting, right. That's the fifth activity of daily living. And as you walk out the door, you want to make sure that you don't need to find a restroom again, and that's continence. Being able to hold what you had for breakfast, lunch, or dinner, and do that in a reasonable way. So that's your sixth activity of daily living. So mobility, bathing, getting dressed, feeding yourself, toileting, and then continence.
Very good.
Those are your six.
And those are things that honestly you take for granted.
We all take them for granted. And if you need help with two of those, heck, even one is troubling. But right. If you need help with two on a consistent and regular basis, you are deemed to be in a long-term care state.
Okay. All right. Well, that stage set, thank you very much for that. Then let's pivot to, you understand now, listeners, what it's like if you need long-term care, if you have an extended healthcare event. And honestly, Jay, at this point in most people's lives, if they have family, they've probably seen one of their family members or friends go through this anyway. So this is really personal to a lot of people.
Oh, it's no doubt. I will, we don't guarantee much in our business, but I guarantee that somebody listening to this podcast knows somebody or a family that's had to deal with a loved one dealing with long-term care and having to take time out of their day, their routine, their family, their job in order to make sure that that loved one, whether it's a mom, dad, brother, sister, grandma, or grandfather, aunt, uncle, doesn't matter. Could be even be a neighbor out of the kindness of your heart. Somebody knows somebody that's had to put their life on pause in order to assist a loved one or a good friend with long-term care situation.
Very good. Well, so Jay, we're going to talk about the 4 broad ways to actually pay for this long-term care event. And what I want to do is start with probably the question you and I get the most when it comes to the financial impact of an extended healthcare event, or planning for it, if you will. Why don't I just self-insure?
Good statement, Josh. And self-insure has been the coined phrase for many, many years. However, I will say there is no insurance in self-insure. You're self-paying. You've identified, earmarked an asset, whether it's an annuity or a piece of property you're going to sell should something come up, or maybe a percentage of a business, or even your home, or maybe the assets that might be sitting in your retirement account or what have you. You've earmarked a certain bucket of money that says, I'm going to use that should I need care at home or if I needed care in a facility care. 2 types of facility cares. There's assisted living, which gives us the long-term care need that we would be looking for on a daily and routine basis. And then there's full-on nursing care. I need 24/7 care. So whether you receive that care at home or in a facility, assisted living or nursing, those dollars have to come from somewhere. So whether you call it self-insure, I don't call it self-insure because there's no insurance. Right. Insurance is purchasing something to help pay or offset the cost of an adverse risk situation. So long-term care, self-insure, let's rephrase that to self-pay. You're just identifying the asset. Now, how long will that asset last? Who knows? Depends on the level of care you need, how long you need it, and where that asset is positioned, and is it in growth mode.
Well, yeah, and you and I did an episode on this a couple of years ago, one of our first episodes, and I don't remember the exact daily figure or monthly figure on what it was to pay for a facility, but my guess is it's gone up even since we did that episode, and it was a pretty sizable number then.
Yeah, so there are a lot of calculators out there. If you just simply type in long-term care, cost of care calculator, you might see a couple of companies' calculators pop up. You'll see Genworth, they have one that goes state by state. Actually, I've pulled it up on my phone right now, and it's a survey, and what they've done is they update it each year, so we actually see the 2021 figures here, and we can see what the monthly cost is for in-home care services. So in 2021, that was $5,100 a month to have somebody come over to the house and assist in in-home care. If you were looking for something a little bit out of your home, maybe go into an assisted living facility, that was around $4,500 a month. And then if you needed full-on 24/7 care, you could do a semi-private room for $7,900 or a private room for $9,000. Now, that's the national median cost. Right. Knowing we have listeners all over the country, right? Every Dollar Counts has listeners all over the country. If you said, well, Jay, how about we plug in a specific zip code? So what I'm going to do is plug in the zip code of the city of Mobile. Okay. And we're going to hear those numbers come down. What were they? 5,100, 4,500, 7,000, and some, and 9,000. And 9,000. Yep. So when I'd recalculate for compare location, Mobile and this general area is calculations that we want to look at for the city of Mobile. In-home services, $3,800. Monthly cost in 2021. If we needed assisted living, $3,500. And then nursing home care was roughly $6,600 for semi-private or just under $7,000 for private rooms. So much less than the national median
about
cost.
15%.
Yeah, so
still big numbers.
Roughly a 15% drop. But yeah, again, big numbers. Now, those are monthly. Multiply those times 12. Right. And you're seeing an annual cost here of, if we round it up on I want to stay at home and I'll have somebody come to the house, that monthly cost today is roughly $4,000 a month. Yep. Multiply that times 12, $48,000 a year. Let's go ahead and call it 50. And how long will you need that care? Who knows? 2, that would be 100,000, 3, 150, 4, 200, and that's in today's dollars.
Number gets big quick.
If we wanted to project that out, just to say we're 65 years old listening to this thing, and we want to see if we need the care at our age 75. Well, that assisted living care is now $5,100. So we're back up to what today's cost national median are in national cost average. That's what it would be 10 years in Mobile.
Very good. Well, so what that leads me to say back on the original question, why don't I self-insure, which we redefine as self-pay, is quite honestly, often there's not that amount of enough liquid assets to self-pay. And then you start getting into selling assets, which is very painful when you're selling under the gun. A lot of times you're asking for family help, and not that your kids or cousins or anybody related to you doesn't mind helping you, but obviously there's a financial impact on them as well. So what I want to do, Jay, then is I want to pivot with that information to how people have historically tackled the problem of affording long-term care, and that is with a traditional LTC policy. Let's talk a little bit about that.
Yeah, so if we realize we don't want to spend our own money and we don't want to be a financial burden to loved ones, we go and look for a solution. One of the solutions is traditional LTC. I equate that to very similar to a homeowner's policy on your house, or even an automobile policy. You're buying something to protect against a risk of occurrence, protecting against long-term care. And in today's world, 2022, we're looking at a monthly benefit that you assign. If you said, I want to buy a $5,000 monthly benefit, and I want to get that for how many years? Well, traditional LTC allows us to get a 2-year benefit period, upwards of a 4 or 5 year benefit period. So we can get a bucket of money. Thinking if I want $5,000 a month, $60,000 a year, I can get a bucket of money of $120,000 to help me offset that cost. And when that $120 is gone, it's gone.
Right.
I can project that out a little bit further. I can go out to 5 years, and so instead of $120,000, I can go up to maybe $300,000 bucket of money. But I'm not going to be able to get much more out of the length of time unless I bought more benefit. You're going to pay a premium for that. You can pay it on a monthly or a semi-annual or an annual basis. It's money that you spend. You can get some tax deductions on traditional LTC costs based on your age, and you'll need to consult with your CPA for that tax deduction. However, at some point, that benefit will no longer be there, and you'll need to come out of pocket for the remainder of the costs. So traditional LTC historically has been the least expensive. It does have us a bucket of money. However, the drawback, and this is what everybody needs to know, the drawback with traditional long-term care is the premium rates we pay today may not be guaranteed.
Right.
So we may get a letter from the insurance company that we purchased the product from 10 years from now that says, thank you, Josh, for being a policyholder. Mm-hmm. However, our claims experience has been increased, and we need to charge you more for your long-term care benefit that you're going to receive should you ever need it.
Right. Well, and Jay, also, I see two other issues with it. Again, this is with traditional long-term care, how it's normally set up is, just like you said with homeowners insurance, well, I pay homeowners insurance and I never have a fire, I never have a hurricane, I never have termite damage, I never have anything. There's if you don't use it, you lose it component to traditional long-term care, right?
Yeah, we mentioned that there is some tax deductibility component to it. However, it is a use it or lose it product.
Right.
You pay a premium, you don't get anything in return for that premium. There are a couple of hybrid solutions that we'll talk about in a little bit that you can get some of your money back. However, traditional LTC, pay a premium. That premium is gone. You've paid for the risk that you want to cover.
Well, I think the insurance company has learned over the years as it's gathered more data and the United States has gotten older, particularly with baby boomers, that the traditional long-term care structure, I don't want to say was broken, but definitely had quite a bit of things happening where there wasn't consistency across the board. There was rate increases. There was people upset that maybe they didn't last as long as they'd hoped it would, and so on and so forth.
Well, the biggest thing was they kept the policy.
Yes.
Life insurance companies price into the pricing of them that somebody's going to drop their contract.
Yep.
Nobody drops long-term care once they get it.
Very true.
They want it there when they need it. And as the percentages of people increase over time as they get older, it's something like 50% of the people age 65 or older are going to have a long-term care event. You're going to need it.
Well, so
and if you don't, the one you're married to or living with,
Right.
they're going to need it.
Statistically, there's a very, very high chance. So what I want to do is pivot to some of the solutions that they've brought to the table, not necessarily in the last couple of years, but definitely newer in the whole scheme of things. Let's talk about the different hybrid ways of handling the cost of long-term care. Let's start with, is there a way to use life insurance and a rider to handle the cost?
Yeah, so these products came out years ago. All the insurance companies, all the A-rated companies that we represent through Concourse Financial Group and that you quote through us, Josh, for your clients, if you look at a universal life contract or a whole life contract, there's not too many of them that offer it on a term life contract. So you need to have something that's going to be there for a longer duration than 10 or 15 years. You can purchase a rider if you still have a death benefit need for your own personal planning or your business planning. And that might be wanting to pay off debt, not leaving anybody hanging from a financial perspective, purchasing it for legacy planning or estate planning. You can now add a rider to help offset those costs. Some of the riders are true LTC. Some of the riders are indemnity, which means just they send you some cash. True LTC are often reimbursement. So if I spend my dollars at this XYZ assisted living provider, then the rider will pay me back for that cost. And there's full-scale programs in place for all of these people that want these riders, and should they ever need to go on claim, all of the insurance companies have a claims concierge facility or team that's going to assist with making sure that those bills do get paid. But yes, traditional life. So if you need you want to carry a $300,000, $500,000 policy on into your retirement years, you can add, if you have a new policy and go through underwriting to get approved, you can add a rider to help pay for a living benefit, which would be the LTC component, and then have a death benefit. The way that works, some people may be saying, well, do I get both? No, you don't. If you go on claim while you're living, obviously for LTC reasons, they will simply deduct the amount of money you use from the death benefit component. So if, Josh, you have a $500,000 policy on yourself, you go on claim, and over a few year period, you spend $200,000 of that for LTC expenses, then the residual goes to your beneficiaries income tax free. That would be $300,000.
Well, and that kind of solves one of the problems we just laid out with traditional long-term care, because statistically, there's a high chance of folks needing long-term care. There's a 100% chance that you're going to die.
Absolutely.
Right. So one way or the other, as long as you're keeping the policy in force, yes, you could argue that paying for the rider and not needing it, those are dollars that you spent. However, typically the death benefit is large enough that you're made whole or reasonably whole upon death. Fair?
Yeah, and you insert it as part of somebody's comprehensive financial plan. You make sure that it's it's needed and desired, and you do have to qualify. You got to be in good health. They will look at your mortality and your morbidity to make sure that they're covering their bases. And I'm talking about the insurance company underwriters, but definitely a solution that we're seeing in the marketplace. People as young as 45 years old looking at it. I'm 45 years old this month. I'm starting to consider it, and maybe we'll have something in solution for my family and hopefully not have to ever use it. But if I do, I'm going to want to have something. So I'm looking at that in the next couple of years as part of my overall financial plan.
Very good. All right. So let's talk about the last strategy for handling long-term care. And it kind of falls under the hybrid as well. It's something that I've actually used in my practice, and that's asset-based long-term care. What does that look like, Jay?
So asset-based, if you remember the first solution, which you called self-insure, and we're going to rephrase as self-pay, if somebody's identified a component of their overall financial portfolio as earmarked for LTC expenses, we can show those people how to leverage those dollars and perhaps turn $1 into $3 or even $4 based on their age and their health. That $3 or $4 bucket of money. So leverage is very powerful. And there are different insurance companies out there. We represent through Concourse Financial 3 or 4 different companies where you can single premium pay or 5 pay or 10 pay or even lifetime pay a solution into this product. What it does come with is it doesn't come with a huge death benefit. It just makes sure that your beneficiaries would receive money should you never use the LTC benefit. But when you get that additional leverage, $3 or $4 to your $1 you put in, that is comfort in knowing that you're going to help offset some pretty significant expenses down the road. And should you need to get that asset back or have equity that you need to, if you want to cancel the contract or if you need an emergency reserve, those policies have cash value that you can grab and use as you see fit in an emergency situation. So in effect, they too come with some sort of return of premium. So self-pay, option 1. Traditional is LTC is option 2. Life, and you might have a need today, life with the rider, or then 3, the asset-based solution. And those come in either an insurance form or an annuity form. A lot of our listeners may be saying, well, I've got an annuity. Does it have a LTC rider? We don't know. You probably need to call Josh and find out. But a lot of older annuities may not have an LTC component, and you can transfer annuity to annuity, still get some leverage, and turn that annuity benefit into an LTC benefit if you ever need it, and it comes out income tax free. So very powerful tools that are available in LTC planning. And again, we're seeing in 50, 55, and up in people wanting to see it. We can go all the way up to age 85 on those solutions.
Wow. Okay. Well, Jay, that's a great job of summarizing it. And listeners, if this topic applies to you, and I would say, yeah, it probably does in some degree.
Either you or your parents or your loved ones. Yeah.
Yeah, I think that's fair. Well, we can help. You can reach out to start a conversation by calling 251-327-2124. If you don't reach me, leave a message. Plus, you can visit gulfcoastfa.com. That's gulfcoastfa, as in financialadvisor.com. You independent and semi-independent advisors and agents out there listening to the expertise and the value that Jay Stubbs could bring to your practice, you can find him at jstubbs.com. That's JAYSTUBBS.com. Well, another show in the can. Great job, Jay. I mean, this one we knocked out.
Yeah, Josh, this is things that you and I deal with every day,
right.
But it's still in the marketplace, still people needing these solutions, and they want to hear about them, so why not do a show on it?
Well, it was great to refresh my memory as well. So many thanks to our producer, Johnny Gwynn, here at Deep Fried Studios. Many thanks to my co-host, Jay Stubbs. And as always, a huge shout out to all of you that have joined Jay and I on this journey, and to those of you that are joining us now. Do me a favor, please subscribe on the Apple Podcast app or wherever you get your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, if you like the show music, go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.